What's good, everybody? It's your boy JTL, Opposite from the Norm. And real quick, I just want to let y'all know about Opposite from the Norm apparel t-shirts. Brought to you by GFam G-Wear. You like our show and our content? Then go to gfament.com and click on G Store, and there you can purchase an Opposite from the Norm t-shirt. Also, you can check out other great tees that represent true kings and true queens as well. Shirts that motivate and make you feel great. Once again, that's gfament.com and click on the G Store link to get your apparel tees. Now back to the show. Chill. What's good, everybody? It's your boy JT, Opposite from the Norm. Back to y'all with another Financial Friday. So before we get started, make sure you like, share, comment, and subscribe. And I'm gonna let my boy HD go ahead and do his thing.
What's up, y'all? This your man HD. I'm coming to you this week with some more news and information to spark your brain, give you a little bit more knowledge into the financial world. This one is something that I picked not only just to others, but also for my damn self, because this is something that we all face at some point in time, whether it's dealing with a credit card, a new car, a house, just anything in regarding to borrowing. So today we're going to speak about interest rate. So I'm gonna break down the basic meanings behind the interest rate, how it works, and give you a couple of examples. And then from there, I'll give you some websites to where you can go on and get a full, more detailed breakdown of interest rates, how they work, how they affect you. All right. So starting off, definition. Interest rate is the amount a lender charges for the use of assets expressed as a percentage of the principal. The interest rate is typically noted on an annual basis known as the APR, which is annual percentage rate. The assets borrowed could include cash, consumer goods, or large assets such as a vehicle or building. Interest is essentially a rental or leasing charge to the borrower for the use of an asset. In the case of a large asset, such as a vehicle or a building, the lease rate may serve as the interest rate. When the borrower is considered to be low risk by the lender, the borrower will usually be charged a lower interest rate. If the borrower is considered high risk, the interest rate that they are charged will be higher, of course. Risk is typically assessed when a lender looks at a potential borrower's credit score, which is why it's important to have an excellent credit score if you want to qualify for the best type of loan that you're looking for. For the loans, the interest rate is applied to the principal, which is the amount of the loan itself. The interest rate is the cost of debt to the borrower and the rate of return for the lender. Interest rates apply to most lending or borrowing transactions. Individuals borrow money to purchase homes, to fund projects, launch or fund a new business, or pay for college tuition. Businesses take loans to fund capital projects and expand their operations by purchasing fixed and long-term assets such as land, buildings, and machinery. Borrowed money is repaid either in a lump sum by a predetermined date or in periodic installments. The money to be repaid is usually more than the borrowed amount. That's the key, since lenders require compensation for the loss of use of the money during the loan period. The lender could have invested the funds during that period instead of providing a loan, which would have generated income from the asset. The difference between the total repayment sum and the original loan is the interest charge. The interest charge is applied to the principal amount. Simple interest rate. A simple interest rate is determined by multiplying the daily interest rate by the principal by the number of days that elapse between payments. So that is P times I times N, which is, as I just explained, the P is the principal multiplied by I, which is the daily interest rate, multiplied by N, which is the number of days between payments. Okay, now we're going to go on to something else. The compound interest rate method. This means that the borrower pays even more in interest. Compound interest, also called interest on interest, is applied to the principal but also on the accumulated interest of previous periods. The bank assumes that at the end of the first year, the borrower owes the principal plus interest for that year. The bank also assumes that at the end of the second year, the borrower owes the principal plus the interest for the first year, plus the interest on interest for the first year. Now we're going to go into what is APR versus what is APY. Okay, so interest rates on consumer loans are typically quoted as the annual percentage rate, which is the APR. This is the rate of return that lenders demand for the ability to borrow their money. For example, the interest rate on credit cards is quoted as an APR. So, in another example that you can have is you can go into one of these websites that I may name at the end, and you can put in, certain things that'll, let you know what your APR is before, you even think about, taking out, a credit card, because some people, they just go blindly like, oh man, this credit card is offering me 2,000, I'm gonna just take it, but they don't, take the time to look at what the APR is, and then that gets them into a world of trouble. All right, so now on over to annual percentage yielded, which is APY. That is the interest rate that is earned at a bank or credit union from a savings account or a CD, which is a certificate of deposit. This interest rate takes compounding into account. Last one I'm going to speak on is IRD, which is interest rate drivers. The interest rate that's charged by banks is determined by a number of factors, such as the state of the economy. That's something that even I didn't know or understand. So I'm giving my own self some scoops. A country's central bank sets the interest rate, which each bank uses to determine the APR range that they'll offer to, their customers. When the central bank sets interest rates at a high level, the cost of debt rises. When the cost of debt is high, it discourages people from borrowing and consumer demand. Also, interest rates tend to rise with inflation in the economy. So that was just a broad scope to give you some knowledge of what an interest rate is when it comes to you and your everyday life and in your future. Some websites that you can go to that are really good is Investopedia. Investopedia gives you a very long and detailed breakdown of what an interest rate is. It gives you different examples. It also gives you statistical examples so you can see what the numbers look like and how it affects you. You can also go on bankrate.com. You can go on nerdwallet.com as well. Those websites give a very good breakdown. And then also for some of the places that you may bank with or credit unions, you can go onto their websites and they should have an area where it can break down interest rates. And on some people, if you do online banking, in your online banking, when you go in to look at your own, checking, savings, it should have somewhere in there in the menu where it'll, say, hey, you want to sign up for a credit card, or if you're interested in taking out a loan, and then it'll also break down, interest rates, how they work, and like standard interest rates as well. So that was this week's Financial Friday. It's your man HD. I hope you take this information, put it into your everyday life, pass this information to your friends, family, also to your kids. We need to start teaching our young generation, our young girls, how these things work for as credit cards, interest rates, and things like that. We don't want them to, leave our nest once they graduate high school, go into college blindly, because that's when these people, even on college campuses, they have people walking around, trying to scout, hey, yo, check out this credit card. You need some money? You broke? Holla at me. I got this credit card. Oh man, I see. Look at your shoes, man. Your shoes looking kind of dusty, man. You want some new Jordans? Yeah. Come check out this credit card. And then these young people, they see the money, but they don't understand that money that they're taking on this credit card that they're borrowing is not just that. It's going to be more added on to that, and then that's what gets our kids into debt, and then we're starting them off the wrong way. So we definitely want to be teaching our young brothers and your sisters at a very early age on interest rates and how they work. Once again, this your man HD, one half of Opposite from the Norm, signing out. Peace.